Greetings and welcome to today's webinar, Understand the Secure Act, the Repeal of the Cadillac Tax, and Other Health and Welfare Developments, presented by Quarles & Brady. Excuse me, my name is Mike Weber, and I'm a member of our firm's employee benefits team. I'm co-presenting with today's webinar with my attorney colleagues in the Quarles & Brady Employee Benefits Group, John Barlamant, Brooke Monahan, and the newest partner on our team, Carolyn McAllister. To start, each of us will give a brief self-introduction. For me, I've worked for almost 20 years as in-house counsel with two nationally recognized trustees and plan record keepers before joining Quarles & Brady's employee benefits team in 2017. I assist clients with the design, implementation, administration, and termination of employer plans and guide plan sponsors and trustees through the landscape of fiduciary investment rules and providing advice on fiduciary best practices. When disputes arise, I frequently negotiate and try to achieve the optimal outcomes I can for my clients. John, maybe you'd like to introduce yourself at this point?
Sure, thanks, Mike. I'm John Barlamant, and I represent employers, third-party administrators, fiduciaries, brokers, benefit consultants, sort of the whole gamut here of folks in the benefit space. In terms of employee benefits law, with an emphasis on health and welfare plan matters like the Affordable Care Act, ERISA, COBRA, and mental health parity. I also have a lot of expertise and experience with data privacy and security issues relating to HIPAA and also multi-employer plans. Brooke, do you want to give a quick introduction?
Yes, thanks, John. I'm Brooke Monahan. I also have in-house counsel experience before I joined the employee benefits team at Quarles & Brady. I generally advise both public and private companies with respect to compensation and benefits matters, mostly in connection with mergers, acquisitions, public offerings, and other corporate transactions, as well as general compliance and regulatory matters. I have significant experience with complex tax, disclosure, and other legal issues arising in connection with the development, implementation, and administration of benefits and compensation programs. Carolyn, would you like to introduce yourself as well?
Sure. Thanks, Brooke. I'm Carolyn McAllister, and I recently joined Quarles & Brady as a partner in the employee benefits group. I come to the team with 14 years of experience advising employers on all aspects of employee benefit plans. I work primarily with public and private companies and tax-exempt organizations. I help these employers on any benefit issues with an emphasis on retirement plans, non-qualified deferred compensation arrangements, and executive compensation.
Okay.
Yeah, back to you, Mike.
Oh, thank you. Well, before we begin the presentation, we have a few quick housekeeping items to go over. We will be applying for 1 hour of CLE credit, and if you're an attorney and like to receive CLE credit for attending today's program, please fill out the CLE form located at the back of the materials, found in the handouts panel in the upper right corner of your webinar dashboard. Please complete the form and return it to the contact listed at the bottom of the document. There's also an HR attendance certificate form in the dashboard materials for human resources professionals to use in self-reporting. We are muting all phone lines for those dialing in and for participants listening to audio via computer, so you won't be able to speak. We're in listen-only mode. We'd like you to be aware that the presentation is being recorded and an electronic survey will be emailed to you after the program. If any of the webinar participants have a question, please type your question in the chat box located in the upper right-hand corner of the webinar dashboard and submit. Every effort will be made to answer questions near the end of our time together today. Without further ado, let's go ahead and begin. I will point out that the general presentation, we will be sort of passing the baton back and forth among ourselves here, primarily in the first part between myself, it is Mike, as well as Carolyn and Brooke, and then John will be covering a lot of the health and welfare materials towards the end of the presentation. So with that in mind, what prompted our discussion today was the Secure Act coming out. It's just a little very quick background here before we jump in. For those of you who presumably have seen commentary out there, on December 20th, 2019, the Secure Act, which is excuse me, get used to changing my slides. The Secure Act was signed into law by the president. It had been out there for really a good portion of 2019, but really just couldn't find its way through Congress for any number of reasons, and ultimately was attached to a late end of the year appropriations bill. It is expected to have a significant impact on the retirement plan landscape, as you see we have here. And so we wanted to really come back to our clients and try to give you a little bit of the Quarles and Brady perspective on the law. By now, I think many of the people on the phone have seen some of the general commentary out there from any number of professionals. But really, our goal today is to try to give you a little more than just reciting the law, and certainly really not focus on that, but focus on what we think are some of the things you need to start considering and when you need to consider them, so that you go into 2020 and beyond starting to consider your options, and as well as where you're going to be going and when we need to have plans amended. So with that in mind, we're going to go ahead and flip to our first substantive slide here, pooled employer plan. Now this, despite the fact that it's in the Secure Act, is going to really have a very specific audience. I'll note right out of the chute that the plans impacted are going to be really limited to probably qualified plans, what we call 401k plans, profit sharing plans, other defined contribution plans, money purchase plans. Right now, as it stands, the remaining items listed here are not directly impacted by a pooled employer plan option. Rather, the only way they would be officially impacted is if a plan sponsor decided they wanted to switch from one of those options to a pooled employer plan. So to talk a little about what a pooled employer plan is, it's really a variation on what we historically call the multiple employer plan. A multiple employer plan is a plan that is for employers that aren't legally related at the level that the Internal Revenue Code requires them to be treated as under the control of the same employer. In other words, about 80% common ownership. The thing about a multiple employer plan is that it required a certain amount of commonality of interest. So it would be something, for example, organizations that had a similar purpose might participate in a multiple employer plan. The beauty of a pooled employer plan is that is, to the large extent, it's really not entirely taken out of the requirements. A pooled employer plan, rather, is a plan where you would have a sponsor, which could really be any of a number of different types of organizations. There really are no limitations. We expect that maybe we'll see trustees, record keepers, that sort of maybe investment managers be the sponsor behind this, along with a single trustee, but having a collection of, most likely we expect, smaller employers who really don't want to have the outlay of assets and complexity of having their own plan, but would rather want to make a vehicle for retirement savings available to their employees without spending a lot of their own time and effort doing it. The idea of the pooled employer plan then is that the plan will be a single plan for a bunch of entities that are not under common ownership, but rather entities that want to have a plan, but really, again, don't want to have necessarily the complexities, and that maybe some of the smaller plans like a simple plan or a SEP really don't meet the needs of what they're looking for. Some of the beauties of this are, again, that commonality requirement is no longer a part of this, nor is there the one bad apple rule that often concerned people historically about multiple employer plans in play. That term one bad apple really referred to the fact that if you had one employer that screwed up or didn't handle their portion of the plan properly, they could essentially bring down the whole plan. Rather, there's procedures that are proposed out there and that will be developed over the coming year or so that really explain how to avoid there being an employer who does something bad from poisoning the well for the entire group of participating employers in the plan. You want, as a participating employer, you won't completely shed your fiduciary responsibility. You're still going to be responsible for picking a good provider, and my guess is that you'll see some of that marketed out there, and ultimately for the investments, except to the extent you've shifted that responsibility. But again, as is much often the case in the world of ERISA, it's impossible to shed all of your fiduciary responsibility, but you will be able to limit your responsibility to just a few smaller things. I guess at this point, the effective date of this isn't really till down the road, as you can see. It wouldn't be effective till after till the end of this year. So really at this point, it's a matter of considering the benefits and costs of switching to this kind of design. And so there'll be some discussion and consideration by a lot of employers. With that, I think I make one comment at the bottom there. A challenge for the potential sponsors here is collecting deferrals. So we'll see if there's any issue there that some plan sponsors are going to be, or the PEP sponsors will be looking for a certain level of protection. With that, I'm going to turn it on over to Brooke here, who is going to take us on to our next slide about QACA auto enroll maximum percentage.
Thanks, Mike. I'm sure you're all familiar with the qualified automatic contribution arrangements where an employer can have eligible employees automatically enrolled in a plan unless they opt out. Under previous law, automatic escalation clauses were permissible, which would allow the employer to increase the amount that an employee contributes to a plan up to 10%. And this has been increased up to 15%. And the idea behind this is it will, allow for greater retirement savings and greater participation in these plans. This change is optional. Employers don't have to make it, but they can if they choose to do so. They would just need to amend their plan documents to reflect the increase and notify the participants. And they can start making the change anytime because it's effective as of 12/31/19. So anytime if the employers feel like this is appropriate for their workforce, they can amend their plan to allow for the increased contributions. And I think the next provision that we found to be interesting is they attempted to simplify the 401k safe harbor rules in these new regulations. I think the idea behind it was to allow greater flexibility for plan sponsors and improve employee protections. So the first thing they did was remove the requirement to distribute a safe harbor notice to participants on an annual basis. I think the idea behind this was that it would reduce the administrative burden for the employers. And the next, maybe more significant change is that it also permits sponsors to adopt or elect safe harbor status anytime before the 30th day before the end of the plan year if they are giving a 3% contribution. And this timeline is extended to the last day of the following plan year if the sponsor is making a contribution of 4%. Rather than the standard 3%. So I think the extended period allows for more flexibility for the plan sponsors to determine whether, it's necessary or advisable for them to make this election. For example, they can now have a little more flexibility to wait and conduct their testing to see whether or not it's necessary to correct any failures. So this will give plans a little more ability to determine whether or not this is the best option for them. And another attempt to sort of allow more businesses, in particular smaller businesses, to establish retirement savings. The next important piece of the legislation was to increase the startup credit for small employer plans. And so I think they're trying to encourage more businesses to establish retirement savings for their employees, and this is an attempt to make it more affordable for those type of businesses to do that. In order to make it more affordable, they increase the credit for plan startup costs incurred by small businesses while they're establishing and administering a new retirement plan. So they increase it. The credit is now equal to the greater of $500 or the lesser of $250 multiplied by the number of employees eligible to participate, or $5,000. So the maximum amount would be $5,000 for the credit. This would be increased by $500 if they include an auto enrollment provision in their plan. So this is a nice way. Oh, and the credit applies for up to 3 years. And so this is a nice way to encourage smaller businesses to adopt such plans. It makes it a little bit easier for them to do so because sometimes the financial cost of establishing these plans makes it not financially sound decision for them. So I think this will help employees of smaller businesses save for retirement as well.
Here.
Oh, I think
did we overshoot one? There we go.
Sorry about that.
Sorry.
Thanks, Brooke. This is Carolyn. So one of the purposes of behind the Secure Act was to expand the opportunities for individuals to increase savings. And this is kind of the first provision that we're going to talk about that really does that. And so it allows individuals who have turned age 75 to continue to make contributions to a traditional IRA. So we see this kind of impacting workers who maybe leave their traditional employment and then do some sort of gig working or some kind of phased retirement, and they'll have some income and still want to save but may not be eligible for a traditional 401k plan. And so now they'll be able to continue to make pre-tax contributions to a traditional IRA up to the limit. You know, this was previously allowed, you could make Roth IRA contributions before this change, but now workers will be allowed to make traditional IRA contributions as well. So the next provision I wanted to talk about is related to plan loans. And as you're probably familiar with, generally whenever you take money out of a 401k plan, it would be treated under IRS rules as a distribution. But there are special provisions that if they're followed as to operation and the amount of the loan, and it's paid back properly, that a participant would have access to retirement funds before retirement and be able to pay them back in the form of a plan loan. And this is a provision where I kind of think, you know, we really shouldn't have to tell the industry this, but evidently Congress had to, that you can't actually treat your 401k account as a piggy bank and use a credit card to obtain a loan. But anyway, evidently there were some providers that thought this was kind of a nifty idea and started to allow it, but effective as of enactment of the Secure Act, that's no longer permitted. And you have to go through the regular process to obtain plan loans. And if anyone used this provision after 12/20/2019, then those quote loans will actually be treated as deemed distributions. So the next item is about the portability of lifetime income options, which can be different types of investments, but kind of what we think of traditionally as an annuity. And one of the other objectives with the Secure Act was to include provisions related to lifetime income options and annuities to kind of take away some of the barriers that some employers were seeing to having these options under the plan. And one of the concerns with different types of annuities or other lifetime income investments is that there can be fees if a participant was only invested in it for a short time. So if the plan offered it and at some point took away that option, that somehow the individual would be burdened with fees or somehow lose a portion of the investment. And so what this rule does is it allows employees, if the plan decides to eliminate a lifetime income option from the plan, they would now have the ability to take a distribution, an in-kind distribution of that investment, and then roll it into an IRA instead of having to potentially, you know, liquidate that investment and be subject to whatever fees or other restrictions would apply.
Okay.
And I'll turn it back over to Mike now to talk about 403B plans.
Thank you. So one of the things that's been a challenge over the years with 403B plans, I think, is at the point that a plan sponsor is looking to wrap one up or really wants to change format. How do you really shut one down, especially even if you're switching from one 403B program to another? How do you shut it down? This provision in the law is going to give us a little more option. In fact, you'll see, interestingly enough, it can be effective as far back as 2008, back about the time that 403B plans had to even have plan documents. So what this is going to allow plan sponsors to do here is going to allow them to have, as you see here, distribute individual custodial accounts or annuities, depending on the structure, in connection with a plan termination. In other words, really not be stuck forever with a custodial account or an annuity contract they simply can't shed and that they kind of have residual responsibility for. It's going to allow a plan sponsor really to hand the reins over to the participant. I think probably akin to an IRA is what it would be, an IRA rollover or forced rollover, to put the money in their hands, put control in their hands, and then move on. Again, much like you see in the qualified plan context, when you terminate a qualified plan, the forced out that's available there, this will expand this into effectively into the world of 403B, and again, be able to get that money out and be done with the plan when it's time to move on from that. I'm going to go flip it back over here to Brooke to talk about one of the kind of interesting perspective revisions here that we see coming up, although as you'll see, Brooke will talk about, it's sort of effective now, but not sort of effective for a long time. Brooke?
Thanks, Mike. The next provision deals with part-time employees, and I think one of the main purposes of the Secure Act is to help expand retirement savings opportunities for a larger percentage of the workforce. And I think under the previous law, employers could exclude part-time employees or those who work fewer than 1,000 hours per year from their retirement plans. And in order to assist a larger portion of the workforce in preparing for retirement, the new law now requires a dual eligibility provision under which employees must either complete the 1,000 hours of service or whatever requirement is there, or they need to work at least 500 hours per year for the last 3 consecutive years in order to be eligible to participate. So this will open up participation to a greater portion of the workforce, especially for employers who have a lot of part-time employees. It will expand opportunities for them. Any age requirements that are set forth in the plan will still apply, though. And what's interesting, employers will not be required to make non-elective or matching contributions for these employees who become eligible just through the new guidelines until the employee has satisfied the general eligibility requirements that are included in the plan. So this is a change that's required. Employers will need to amend their plan to incorporate these new eligibility provisions by 2022 and notify participants. But as Mike said, it's interesting because it will begin for plan years starting after 12/31/2020, but the tolling of service for the part-time employees doesn't start until after that date. So any service that was completed prior to 1/1/2021 won't count for these purposes. So practically speaking, the earliest a part-time employee could become eligible under these new rules would not be until January 1st of 2024. So it's really I think the idea is to give plans an opportunity to get ready for this increased participation, especially for employers that have a large percentage of part-time employees that will now be eligible to participate in their plan, so they can make any necessary changes to be able to account for that increased participation level. So move on to the next provision. Is a provision was added to allow for penalty-free withdrawal in the case of births and adoptions of children. And I think this is another way that they're trying to assist employees by allowing a up to $5,000 penalty-free withdrawal within 1 year, if it's taken within 1 year of birth or adoption of a child, without incurring the 10% early withdrawal penalty. And what's interesting is this is done on an employer-by-employer basis, so each parent can withdraw $5,000 from his or her retirement plan if it's permitted under the terms of the plan. So a couple of things. the withdrawal must be taken within 12 months of a birth or adoption. And for adoptions, the child must be under 18 or physically or mentally incapable of caring for his or herself. And the money can be paid back on a pre-tax basis. And I think the idea behind this is to allow for participants to make these withdrawals in life-changing, circumstances where they may need the money earlier than they thought. But also, I think one of the ideas behind it was to encourage participants to begin participating in these type of retirement plans earlier, with the idea that if it becomes necessary, they can, make withdrawals under certain circumstances, such as births and adoptions if they need to do so. This is one of the changes that's optional, so employers can amend their plan to include this, but they're not required to do so. If they'd like to do so, they can amend their plans and provide notice to participants, and it applies to distributions made after 12/31/2019. So if somebody had taken a distribution previously, it can't be retroactive. It has to be moving forward, anything that's done after that effective date.
Yeah, one thing that's kind of interesting there on that too, we've talked about a little bit internally, is the fact that the effective date is for distributions after 12/31/19, with a 1-year window in which to take the distribution. For someone who might have had a birth or adoption in 2019, the clock's running already. The birth or adoption, based on the language we've seen in the statute, doesn't seem to have had to happen after 2019. Rather, the distribution. So you may run across individuals who will be pushing for this sooner rather than later. In particular, if they had a finalized birth or adoption, or if they had a birth or a finalized adoption earlier in 2019. But as Brooke points out, it is an optional provision, and it's something that plan sponsors will really have to work with their providers on to if they desire to go this way, to make it available as soon as sooner rather than later, I guess. I guess, Brooke, should I go ahead and continue on then onto the next page?
Yes.
Okay. Great. Oh, yeah, we both hit at the same time. Okay, difficulty of care payments. So these are payments that are typically received from the government for caring for foster children, and really, I think much like a lot of the legislation, the government is looking for ways to give people an option to make more contributions, to get more contributions in the plan. Effective date is early here, as you can see, back as early as 2015, 9 years after 2015, so 2016. And the difficulty of care payments can be, again, according to the law, can count as compensation for purposes of plans, and people can contribute based on them. One thing that you'll see in the comments here that sort of caught our eye was the idea that it would appear these would be done as true after-tax contributions. Not Roth contributions, but true after-tax contributions, such that they lose a lot of the value that either a pre-tax contribution has, where it's pre-tax and then pre-tax build up, only taxed at the end, or Roth contributions where you pay all your tax up front, but you don't pay tax on the build up and ultimately your distribution. Rather, with an after-tax contribution, the money goes in after tax, but the earnings build up on a pre-tax basis, such that at the time you eventually take the money out, a portion of it that comes out to you would be taxable to you. So it's sort of a second or third best choice, presumably, for most people who would receive these, because they are in fact paid in after-tax dollars from the government, or untaxed dollars. It's probably, I suspect, not going to be a particularly interesting or highly used provision, but it is an option that plan sponsors would have if they so choose to have something added to their plan on it. With that, I'm going to turn it back over to Carolyn here to talk about some of the change of the required minimum distribution rules.
Thanks, Mike. So the next item, again, back to required minimum distributions. This is a very welcome change. As you likely know, the current RMD rules require that for participants who are not 5% owners and who have separated from employment, they would be required to start taking the minimum distributions from their 401k or 403b plan as of April 1st of the year following turning age 70 and a half. And now this new rule, and this is one of the provisions that will be kind of effective immediately, is that instead of having to be age 70 and a half, now employees can wait until age 72, or former employees can wait until age 72 to start drawing down on their 401k or their IRAs and other defined contribution plans. And like I said, this is a really welcome change. We know that people are wanting to work longer or actually preserve their retirement savings as long as possible. So one of the caveats here is that you'll have to look at your actual plan document to see how it works, because even though this is kind of the latest date, some plans take different approaches as to when they require employees to take contributions. But this is, like I said, a welcome change, and it's going to be, it'll impact anyone who turns 70 and a half after, or turns 70 and a half in 2020 or later. So anybody who was 70 and a half in 2019 is still required to take their distributions as of April 1st, 2020. But then for any individuals who'll turn 70 and a half in 2020 or later, then now they'll be able to wait to take their required minimum distributions. And this is one of the things where there's a little bit of a disconnect as to, administratively, this is something that you'll be looking at for either IRAs or plans to make changes and implement this starting in 2020, but you don't actually have to amend your plans likely until 2022 or later.
Okay.
So the next item, also relating to RMD rules, this is kind of on the flip side, though. It's not as favorable to taxpayers, to individuals. This is one of the revenue generating requirements or provisions in the legislation. So under prior rules, there was an ability when someone died before turning 70 and a half, before their required beginning date, to start taking distributions and spread them over the lifetime of the beneficiary. So to maybe give it to a younger child or even a grandchild to try to stretch the taxation of an IRA or a 401k account as long as possible. Now, under these rules, there's a number of exceptions there, but generally, if you're not a spouse or if the beneficiary is not a spouse or one of these other individuals, then all of the payments from the IRA or the 401k will need to be taken within 10 years of death of the participant. And I think there's a little typo here in this slide that it's supposed to say, except for beneficiaries who are not more than 10 years younger. So basically, if it was someone within 10 years of age of the participant, the IRS or Congress is saying that, okay, that's about the same spread out over the lifetime of this beneficiary versus lifetime of the participant. And there is an exception for spouses. So if a spouse is more than 10 years younger, that's still okay. So some people will still be able to spread out the taxation of the account over their life expectancy, but for other individuals, it's going to be kind of a hard 10-year distribution requirement. And yeah, I think this continues on the next page. Just note too that there is no requirement for the amounts to be paid pro rata out of the account over these 10 years. So you can wait until the very end of those 10 years to take the whole amount. It'll be interesting to see how plan sponsors decide to use this, because this is kind of whether they'll really let the money sit there for 10 years and how you'd monitor to make sure it gets out. But that is now an option, and if individuals if the plan doesn't offer it, then the beneficiary can always roll it to an IRA and then have the 10 years to take all the money out.
And I think that's a good point, Carol. And from my TPA days, it really, that monitoring period can be a real challenge, especially if people haven't commenced. It's easy for people for beneficiaries to get lost, and now you've gone from 5 years, in some cases up to 10 years. At least while it may have delayed the benefit to the government of getting the tax money in the door, when it was installments over lifetime of a young beneficiary, that's the so-called stretch RMDs, they usually knew where the person was and the money was coming in. Here, the plan sponsors or TPAs may have trouble, much like they often do for participants who terminate at a young age and have a balance that can't be forced out, and the money sits there for 10 or 15 or 20 years. So it'll be interesting to see how they deal with that.
Yeah, and also just a note here too is that if the participant had a domestic partner that was, or a lifetime partner that was 10 years or more younger, then they're going to get stuck in this rule, as
Right.
opposed to a spouse who isn't subject to the 10-year limitation.
Right.
So the next provision to talk about is about in-service distributions for pension plans and 457B plans. You may have remembered a number of years ago, was that part of the Pension Protection Act, where they had changed to allow in-service distributions from pension plans at age 62. And from like the retirement community, that seemed a little inconsistent with some of the other requirements that allow under like a 401k plan to allow in-service distributions at age 59 and a half. So Congress has now, this is, I guess, another revenue generating provision in the law, where now plans, it's optional, but plans can allow in-service distributions at age 59 and a half. So this will let individuals who are planning to retire at that time have some consistency in planning for their retirement income, because now they can access their pension or a money purchase plan at the same time they can access their 401k or an IRA.
Yeah, and I know I've got a typo in the slide here. It should be defined benefit at the top rather than 457. My apologies.
Oh.
Yeah. So.
Back to you, Brooke.
Thanks, Carolyn. So I think the next few slides will talk about some administrative changes that were made under the new legislation. The first would be that they now had to do with the adoption of new plans. And so now the new legislation permits a business to treat any qualified retirement plan adopted prior to the tax filing date as having been adopted as of the last day of the year. So essentially this allows for a retroactive effective date for certain plans. And I think the idea behind it is it gives employers additional time to consider whether to adopt a plan for its employees, assess design options, figure out what's going to work best for their workforce, and get their documents together. And it also allows employees to start receiving contributions earlier and begin accumulating their retirement savings earlier. One thing to note is that employers cannot retroactively allow elective deferrals with respect to 401k plans. This would only apply to employer contributions. So they could make contributions, but they couldn't do retroactive deferrals for employees. So this will just give employers more flexibility when adopting new plans, especially if they're on the fence and they don't know whether or not they want to do it, or if they have a complicated formula that they need to work out a little bit more. The next administrative change has to do with their Form 5500 filings. And so the new legislation now allows allows employers in the same control group to make a consolidated Form 5500 filing for similar defined contribution plans. And so under the regulations, what's considered similar plan is plans that have the same trustee, fiduciary, administrator, they use the same plan year, and they provide the same investments or investment options. And the rationale behind this is to try and reduce the administrative costs and burden of the filing process for employers, especially smaller employers. This could be a time-consuming and expensive process for them. So I think by allowing them to combine all their filings, they're trying to lessen that burden a little bit. And I think this will certainly help streamline the process and reduce costs to a certain extent. However, each plan may still be required to do audits and compliance testing, which can be costly and time-consuming anyway. So I think the overall effect of this change is still kind of to be determined, whether or not it does lessen the burden as much as we are hoping it will. And another administrative change is the increased penalties for failure to file. So in an effort to encourage filing of timely and accurate returns and statements and improve overall plan administration, the new legislation significantly increases the penalties associated with failure to file retirement plan returns. And this is a significant increase. It's up 10 times across the board from the previous penalties. For example, the Form 5500 penalty, it used to be $25 per day up to a maximum of $15,000, and now it's $250 per day up to a maximum of $150,000. So that's a significant change. So I think the takeaway here is that employers really need to make sure they're working with their administrators, trustees, accountants, and other service providers to make sure they're making their filings when they're supposed to be, and they're not, nothing is slipping through the cracks with respect to these kind of filings, because the penalties are pretty steep.
I'm going to try to keep moving along here so that John has adequate time and hit on these things that I think are relatively straightforward. Disclosure of lifetime income options. Plan sponsors are going to be required to provide information, and probably done through their third-party administrator, about how an account might be used to provide provide an ongoing, like a lifetime benefit, an annuity type benefit for participants. As you can see, the effective date's pretty far out on this. After the latest, the final rules, model disclosure, and assumptions that you need to use to do the termination are all finalized. So it's going to be 12 months after all of that. So that's kind of a stay tuned more than anything else. And again, I suspect that plan sponsors won't be doing this themselves, but will be looking to their third-party administrators to run those kind of calculations, much like they do currently on statements. And frankly, some of this is already probably available through various organizations that will let you model what your account balance would buy, and based on what your account balance is expected to be by retirement, what kind of annuity stream that could provide you at retirement. Non-discrimination compliance options for closed defined benefit plans. So this is really, this is the aging of America issue. We have individuals where plan sponsors have frozen their defined benefit plans to, in what we sometimes refer to as a soft freeze, that no new participants are allowed to get in them. All of the participants who are there continue to get accruals under the defined benefit plan. The upshot of this change in the law is it's going to make that a lot easier to continue to live with as time goes on. What would happen is, over time, as that workforce who was in the DB plan was there, first of all, the numbers of people would drop to a point where testing became impractical or impossible, illegal, what have you, or the people who were in that defined benefit plan were largely highly compensated, and it caused sort of unfortunate testing results. The upshot again of this is it's going to help make it more possible for plan sponsors to continue to maintain those closed DB plans for a longer period of time and allow additional testing, non-discrimination testing options. And then again, allow certain benefits, rights, and features to be available to the group that's in that those DB plans without triggering a discrimination problem. Fiduciary Safe Harbor for selecting annuity providers. Again, in the interest of not getting too deeply into something that we probably don't need to immediately, this is one of the goals of the government of getting people to think about offering an annuity option for participants. I think there's a general feeling out there that while people like knowing what they have, and defined contribution plans are great for knowing what they have, people really don't understand what it means to have what they have. In other words, what can that really do for me when I get to retirement? And so despite probably a general trend away from defined benefit plans, people, the government and others out there are recognizing, well, gee, people don't know how long their retirement income can last. That could become a problem. So we want to see if we want to encourage people to have an annuity option. Take your retirement savings at retirement and buy something that's going to give you a solid stream of income for the rest of your life. And so what this provision really does is it gives plan sponsors an ability to to have an annuity option in their plan. And if they're going to be buying annuities for participants for their benefits, to give them a comfort level that the annuities that they're offering participants are not going, that the plan sponsor is not going to be penalized for trying to do a good thing of offering an annuity option. So it gives them effectively pretty close to safe harbors. If the providers you're looking at, if you've done an objective, thorough, and analytical search for annuity providers, and essentially as long as that provider is in good standing in the state, under the state insurance regulators, that if you offer and you provide an annuity through that type of provider, it's something that a plan sponsor shouldn't have to worry about getting bitten on later for having selected a provider that's not good enough. The 529 plan changes. I'm going to really blow by this very quickly. Very interesting little topic there, I think. Apprenticeship programs can now be a use of 529 plan changes, recognizing that not everybody really, four-year college is not for everybody, but there's some really good job opportunities there, and we don't want to limit the ability to use post-secondary college type savings from other programs that might qualify people to be involved in different trades that don't necessarily go through a traditional college environment. Again, there's also an ability to use 529s to repay certain student loans. Again, happy to talk about with any of you on the phone further later on about that. But in the interest of giving John an opportunity to talk about some of the health and welfare matters that we want to cover today, I'm going to turn it over to him now to take it from here.
Okay, sounds good. Thanks, Mike, and thanks everyone for being here. Yeah, in terms of the changes here that the Secure Act, or the larger bill called the Further Consolidated Appropriations Act of 2020, the FCAA, made, most of the changes are, as you have probably surmised, on the retirement plan side. And so lots of interesting details over there. On the health plan side, it's actually not very much. And what there is generally all good news. And so yeah, so it's interesting and in general good. The biggest change that I think will most interest employers and other plan sponsors and the service providers to plan sponsors is the elimination of that Cadillac tax, the so-called Cadillac tax, which is the 40% excise tax on the excess cost of the high-cost health plans. You all may recall how this was part of the original Affordable Care Act. It was supposed to take effect, I think, in 2018. Got pushed off to 2020, then got pushed off to 2022. Congress kept kicking the can down the road, and this time they finally pulled the trigger and just took out all of the Cadillac tax. And so very helpful. There's a quick illustration, quick example of how it works in this slide. For example, if a family plan costs $30,000 per year, employer plus employee contributions, there was a moving limit in terms of how much employers could provide on a tax-free basis without incurring this excise tax. It started off at roughly $27,500. So if your family plan costs $30,000, the excess is the difference between $30,000 and $27,500, which is $2,500. the excise tax would be 40% of that amount, or $1,000 per family enrolled in the plan. And again, something that employers would have had to pay. Employers weren't happy about that, would have threatened the ability of them to provide health plan coverage. If employers started offering worse coverage, employees would have been mad about it. So it was one of those taxes where nobody was happy at all. So Congress, on a bipartisan basis, again, got rid of it. Who's affected? Everyone with a health plan, at least a major medical plan. It's just overall good news. Really no downside from my perspective. I think everyone's going to be very happy about that. Other little tweaky things in here, again, getting rid of the Cadillac tax, I think is huge, very helpful. They did stick us with a fee that you've been paying here for a while, the PCORI fee, the Patient-Centered Outcomes Research Trust Fund fee. The PCORI fee, again, originally part of the Affordable Care Act. What it is, it's a modest payment that insurers and plan sponsors of self-funded plans had to pay to the federal government. The federal government used that to conduct research into effectiveness of medical treatments, because surprisingly, there's not always good studies on, if you're a doctor and there's two possible treatments, is one 59% effective and the other is 57% effective. Doctors don't necessarily have that kind of hard data all the time. So this fee is used to conduct those kinds of studies to give it to healthcare professionals so they can make better informed decisions. The amount that's generated is kind of substantial, and I think it's like $300 million or so per year at the federal level. But under the Affordable Care Act, it sunset and it went away. So this reinstates it. It brings it back to life. Again, most employers don't really complain about it because the fee is very modest. The fee started at $2 per covered life per year. It gets adjusted for inflation. When it just ended, it was at $245, and now again it's going to be extended through 2029. So it will keep moving up a little bit, but again, $250 per covered life per year or so is really not too bad. We'd rather have it be zero, I guess, but employers, I think in general, won't grumble too much about it. So who's impacted? Again, insurers and employers with self-funded plans. Other quick little points here. The new law also removed the 2.3% excise tax on medical devices and the health insurance tax that insurers of fully insured plans had to pay. With that fee gone, it's possible that the cost savings will be passed on to employers. So again, that's good news from an employer perspective. Other non-statutory changes, just wanted to mention these quickly here as a quick reminder. First of all, the Affordable Care Act, there's still ongoing litigation about whether it should be stricken in its entirety. There was a recent Fifth Circuit decision from, I think, November, in which the court said that maybe it should be just taken out entirely. Every provision would suddenly be gone. But the Fifth Circuit remanded it down to the lower court for more detailed analysis about what should be stricken, if anything, under the Affordable Care Act. The argument is that with the individual mandate going to $0 as of January 1, 2019, there's no constitutional basis for the ACA, so the whole thing has to be taken out. Again, we'll see where that goes. Probably eventually will be heard by the Supreme Court. Another quick reminder, new Centers for Medicare and Medicaid reporting relating to Medicare secondary payer rules begins in January 2020 with respect to your prescription drug plans. Your third-party administrators, if you have a self-funded plan, have been doing that reporting for employers generally for a number of years. PBMs may have to start doing some reporting. If you haven't talked to your PBM, talk to your PBM about this new reporting rule. One other quick note, there are some proposed regulations on transparency and new disclosure rules for health plans. Those just came out recently, less than 2 months ago. No action steps yet. We're going to monitor them to see what happens when they do get finalized. And with that, Mike, I think we're going to look at some questions, right?
Right, yeah, John, I think there's just a question that came in for you. I've got a couple, then there's a couple, I think, probably for you, Brooke, and then one more for me, and then one for John. So I've got 6 questions here right now. The first one was early on in the discussion. It was, does the Secure Act apply to a 457B plan? I think the answer is it depends to some extent. For the most part, a lot of the changes that would apply to a 401k or a 403B plan would similarly apply to a 457B governmental plan, but very few of them matter for a 457B tax exempt plan. Really, the tax exempt plan side of things, the required minimum distribution rules will apply to a tax exempt 457B plan. But for the most part, most of the changes are really more in the traditional vehicles, 457B governmental, 403B, and 401A, including like 401K plans. Second question here, would a PEO, a professional employer organization, 401K be considered a pooled plan? And a nice lawyerly answer, maybe. My suspicion is they probably could do that, but a PEO plan ordinarily I think would be managed and maintained at the PEO level for individuals who are hired out to various organizations. In other words, the individuals who are leased out by a professional employer organization to various entities are employees of the PEO who are leased out, rather than the various plan sponsors being part of a plan sponsored at a PEO level. That said, we may see a change in that regard, such as people who are currently professional employer organizations now become pooled employer plan sponsors, and various employers participate in that pooled plan. But I think at the time being, my guess is that would, based on how the term is ordinarily used, those plans at the PEO level would not be. I think, Brooke, I think the next question is probably for you regarding the $500 business startup credit and who the credit will be applied to with the credit. I think I'll leave that to you, but I think that's probably going to be the government providing that credit.
Right, that's correct. Thanks, Mike. Yeah, that's correct. It would be the government providing the small business credit with respect to establishing the plans. And so, it would be a tax credit for these employers. And I think the next question, I'll cover the next question as well, because it has to do with the addition of part-time employees into the plans. And the question is whether or not the employer would have to make the safe harbor contributions for the part-time employees. And the answer there is that these employees can be excluded from these provisions unless and until they become eligible otherwise to be participants in the plan and eligible for these contributions.
Okay. A question about how much people could contribute for the difficulty of care payment. If the plan sponsor allows a difficulty of care payments to be considered compensation, really would be the entire amount of the difficulty of care payment could be contributed to the plan. Now that could create, I suppose, some potentially interesting problematic discrimination testing results if the people contributing that difficulty of care payment are highly compensated people. I think that's going to be one that we'll see over time whether and how much that really takes hold. But the short answer is I think the entire amount of a difficulty of care payment could be contributed. John, I think the next question about the PCORI fees is probably for you.
Yeah. Somebody asked if we had an exact amount of the PCORI fee in terms of what it'll be. We don't have that yet. The IRS does adjust that for inflation, so it does go up a little bit every year. It was, I think one year was like $2.17, and then it went up 9 cents to $2.26, and then it went up again another 9 cents or so. So, it tends to move up a little bit here. I did look at the statute, and the amount that the federal government is trying to raise in terms of revenue, again, did not jump up significantly from year to year. So I'm guessing it's going to be another 10 cents, 12 cents in terms of an increase, something like that. But yeah, we don't actually have the formal number yet.
It is 1 o'clock, and we're happy to stay on. We have received just a couple more questions. I think literally we're looking at about 5 more minutes. Certainly, you have fulfilled your obligation to the extent you're looking to get continuing education for having been on the call for an hour. But we also invite you to stay, again, for the last few questions, which I think are pretty straightforward questions. I guess with that, the next question I think goes to Brooke. Do the increased penalties for the 5,500 filings impact the DOL's delinquent filer program? Brooke, I've not, since I'm just reading the question, I'm not aware of anything. I don't know if you have had anything, seen anything on that yet.
Right, no, I agree. As of now, that shouldn't be affected, but the DOL may issue new guidance on that as well, but there's nothing in the new regulations that say anything, suggests that that would be changed.
And Carolyn, I think the last 3 questions are for you.
Yeah, so the next question just had to do with what was the typo on page 16. So on the this is about the changes to the stretch RMD provisions. So the very beginning where it says, except for beneficiaries who are more than 10 years younger than the participant, it should say, except for beneficiaries who are not more than 10 years younger. So if you have a beneficiary that's within 10 years, then you're subject to then you don't have to worry about these rules. But if they're more than 10 years younger than the participant, then you're going to be subject to this hard stop, and when you need to take out the distributions, that'll be the 10 years from death. So the next question had to do with, it says, under the new RMD rules, if one defers until April 1st following the year turning age 72, that will result in 2 RMDs that year, correct? I don't know, I would need to confirm this, but I think that it's going to operate the same way as they currently do with the 70 and a half, so that, yeah, if you were required to take it, for the first year, you could, if you defer to April 1st, you would have 2 distributions that first year.
That's my understanding as well. Yeah.
Okay. And then the last question that we have is about the stretch RMD rules and whether those limitations will apply to IRAs as well as qualified plans. And yes, they will apply to both qualified plans and IRAs.
All right. Well, again, thank you for joining us today. Our contact information is there on the cover page, and I believe on the final page of the presentation as well. So don't hesitate to reach out to us, and we will talk to you at our next seminar sometime down the road. Thanks now.